Okay. So we have control over the other company. And if we are having 20 to 50%, we will say significant influence. Influence. Okay. Here we don't have any controllers there. Okay. Now, coming to the consolidation part. Why consolidation is done between a parent and subsidiary? There will be a parent company who is having more than 50% shares in other companies. Okay. So all these companies who have we have invested is called the subsidiaries. Now, subsidiaries can be 100% subsidiary or less than shares. Like, for example, I might have 100% shares in that particular company. That is 100% subsidiary. Okay. There is no outsiders in that company. Okay. So if there is any outsiders in that company, we call them non-controlling interest. Now, we are having 51% shares in another company and somebody else is having 49%, then they don't have the control. Correct. So we call them non-controlling interest. What they have in the business is a non-controlling interest. So even if we have only 51% shares, how we consolidate is that we simply merge the P&L and balance sheet like this. This is the parent company's P&L and balance sheet. This is the subsidiary's P&L and balance sheet. So we will simply merge it together. Okay. Now you might have a question, what about the 49% shares, which is not ours? What about their assets and their liabilities? For that, we will have an item in the balance sheet equity side as non-controlling interest. Clear? Here, we will bring all the amounts corresponding to the non-controlling interest. Clear? Got it?
It's one thing, like
It's
one line item.
Yes, we'll combine it together and show, because maybe if we have like 100 subsidiaries, we can't put all those as separate 100 lines, right? Okay. Now let's see one example here. Now, if you are having individually, independent, we call it as standalone. Standalone. This is of the subsidiary, and this is the parent. But when you have the parent as individual company, okay, then we have the sales, for example, 65,000 as a COGS, selling administration, 15,000, for example. The profit we have, then non-current assets, 3,000. Okay. For example, this is the parent company standalone balance sheet and P&L. Okay. Now, here, when you see there is investment in subsidiary 50,000. Clear? So that will be here as 50,000. Okay. And for example, when you take the subsidiary, we'll have sale of 50,000, for example, 25. Let me be like this. Now what happens? Parent company standalone financial statement looks like this. Clear? Now, in this, they have a 50,000 investment in a subsidiary. Clear?
Yeah.
Okay. Now, and inside subsidiary, you will see the investment from the parent company. That is the equity part. Clear?
Yeah.
Got it. So, Now, when you're going to consolidate those together, then what we'll do? We will simply add the sales together. Everything we add it together. Okay. And coming to the asset sides, also we do the same thing. But you will see one problem here. Now, oh, investments. Sorry, I put investments there. Supposed to put there. So, okay. Now what happens? Here, what happened? Equity became how much? 200, right? But this is actually what?
50,000 is part of that other.
Yeah, 1 second. Sorry. Okay. So what happens here? This 50,000 is our investment in the other company, right?
Yeah.
So when you consolidate, we will not take that investment. Clear?
Yeah.
Okay. So from here, we will remove this investment also. Okay. Why? Because we already taken all their asset sales and everything. So that's why we will not take the investment into our consolidated book. Clear? Now, here, this is, we are talking about 100% ownership.
Mm-hmm.
And only in that case, it will, the method is like this. If you are having investors with other interests, like what we say, non-controlling interest people are there, then all other things are same. Okay. But inside the equity side, we will have a non-controlling interest part, which is a minus amount. Clear? We'll put here non-controlling interest, and whatever the corresponding shares of theirs, we'll reduce it from here, for example. Clear? All other things are same. Even though we are having only for 51% or 60% shares, we will still take 100% of the sales, 100% of the COGS, 100% of the assets and liabilities. Clear?
Yeah, but why do we deduct it?
Why we deduct? Because we show their portion of interest here. So whatever corresponding to them, they, for the non-controlling interest also, just like our equity, they will have their opening balance plus net profit current year. Then yeah, they will have the closing balance. Clear? Now, when we go step by step, you will get more idea. Okay.
Okay.
Now, going to the consolidation accounting. When one entity controls another, consolidated financial statements must be issued by a parent company regardless of the percentage of ownership. Now, one more question. Why we are asked to do the consolidation? What is the idea behind having a consolidated financial statement? There should be some reason, right? Now, for example, if you take here in Abu Dhabi, we have ADCB Bank and we have Al Hilal Bank, correct? Al Hilal Bank is a subsidiary of ADCB, right? I hope you know this, right?
We do know.
Huh?
We do know.
What? I didn't hear that.
We do now.
We do now. Okay. Okay. 4, 5 years back, IDCB Bank brought two banks. One is Union National Bank, okay, and they brought Al Hilal Bank also. But do you ever see Union National Bank now? No, right?
No.
Why? Because what happened? IDCB merged with them, and they removed all their names from the public. Now there is no more Union National Bank. There is only ADCB. Clear?
Okay.
And for the ADC Al Hilal Bank, they brought ADCB, but they kept it as subsidiary only. They didn't merge it together. Clear?
Okay.
Just like when you look into FAB, First Abu Dhabi Bank, before it was First Gulf Bank, then there was Abu Dhabi Bank. They merged together and they became FAB. Clear? So here there is no subsidy is happening. They consolidate and becoming one single company. Clear? Okay. Now, when come to the Al Hilal Bank, Al Hilal Bank is having their own identity, their own staff, their own shareholders, everything is there. But as public, when we see, we feel it that ADCB is a different company, Al Hilal is a different company. Correct. So even we might think that they are competitors also. Correct. But
Yeah.
to show the reality to the public, they are supposed to consolidate because ADCB is holding majority shares in Al Hilal Bank. So we call this as lifting the veil, or what we say, something we used to say. There's one word. I forgot that. We are looking into the reality beyond the legal formation of the company. Clear? If you look into the legal formation, there are two different companies, but the reality is that they are one. Because who is taking decision? ADCB is taking decision over Al Hilal Bank also. Clear? Okay. So that is the reason we are consolidating, so that public will be aware that these companies are not two separate companies; they are single company. Okay. Now going forward. Okay. Consolidated financial statements. A business combination is a transaction in which an acquirer obtains control of another business. Okay. Then control is a controlling financial interest. It is a direct or indirect ability to determine the direction of management and policies of the investee. Control usually is when one entity has direct or indirect ownership of more than 50% of the outstanding voting interest of another entity. We are talking about not about shares, we are talking about 50% or more voting interest. Clear? Why we say here voting interest? Because in some companies, they might have different class of shares. There will be class A, class B shares. So class A shares will have two voting rights per share, and class B shares will be having only one voting per share. Clear? So that's why we say 50% of the outstanding voting interest in the other entity. Then, a parent is an entity with a controlling financial interest in one or more subsidiaries. Then, consolidated statements present amount for the parent and subsidiary as if they were a single economic entity. Now, primary consolidation models are voting interest entity model and the variable interest entity model. Under VOE, variable interest model, financial control is determined by ownership of a majority voting interest that is more than 50%. Then comes the VIE model. That's the one which we will see in UAE most of the companies, because there will be a local owner. He will be having 51% shares, but the decisions will be taken by the other guy. Correct? Okay. So here, under the VIE model, financial control exists even if the reporting entity doesn't have more than 50% of the voting ownership. This occurs when one entity has the power to direct the activities of other entity. Okay. Now, here what happens? There will be an Indian guy who's running the company. He will be having 20% or 10% shares, but he's the one who's taking the decision of the company. Clear? In that case, how much companies he is handling like that, we have to consolidate all his financial statements together. Got it? Okay, now. The controlling entity absorbs the losses or benefits from the controlled entity. The controlled entity doesn't have sufficient financial resources to support its ongoing operating needs. The controlling interest is generally arranged through a contract, not direct ownership. Clear? Here in UAE, we call that agreement as Wakil Khidmat.
What?
Okay. Wakil Khidmat. That's what they say, that agreement. I don't know what is the meaning of that. Okay. Now, the parent and subsidiary may exist separately for an indefinite period, but consolidated financial statements must report them as single economic entity. Then, required consolidated reporting is an example of substance over form. Yeah, this is what I was looking for the word. substance over form. Okay. Even if two entities remain legally separate, the financial statements are more meaningful to users if they see the effect of control by one over the other. Clear?
Mm-hmm.
No. Okay. Acquisition methods. A business combination must be accounted for using acquisition method. It determines the acquire and the acquisition date. What happens in the acquisition date? Whom we are going to acquire, that we have to find out, and the acquisition date, on what date we are going to acquire the other company. On why that date is important, because on that date we have to take the fair value of their assets and liabilities. Okay. Recognizes and measures at acquisition date fair value the identifiable assets acquired, liabilities assumed, and any non-controlling interest in the acquiring. Clear?
Mm.
Also recognizes the goodwill or a gain from a bargain purchase. Now, the consideration transfer to a business combination must be measured at acquisition date fair value. Okay. Now comes to the goodwill. Can a company generate goodwill in their books? For example, I started a business. Okay. I'm running the business for last 10 years. And I feel that I have a market value of 100,000 dirhams. Can I show this as a goodwill in my books?
No.
Yeah. Not possible. We are not supposed to do that. Why? Because we say that internally generated goodwill cannot be recorded in the books. Okay.
Mm-hmm.
There's technical problems also. Why? Because if you are showing goodwill as an asset, then what will show in the other side, credit side? There's nothing, right? Because we assume that the goodwill is this much. Correct.
Yeah.
That's one thing. Then second thing, if I feel that okay, I felt 100,000, somebody else is thinking my business is having a value of 1 million. So
Mm-hmm.
this goodwill amount, if I am internally generating, it could be uh, manipulated. Clear.
Yeah.
Now, then how does the goodwill come in place? First place. So when you having a transaction, when you are purchasing another company, for example, the assets, all the assets what you have in the other company, when you take the fair value of all the assets and liabilities, when you take all the assets and liabilities together, we call it as net asset value, right?
Mm-hmm.
Assets minus liabilities, whatever we left is the net asset value. Now, net asset value is like, for example, 50,000 dirhams. But I'm paying him 100,000 dirhams. Then that means the excess money which I paid is the goodwill. Clear? Okay. Now, you might ask why I am paying 50,000 more. Correct.
Mm-hmm.
Why I am paying 50,000 more? Because I expect this company will bring revenue in the future years for me. Okay. That's a
Okay.
that's why I'm paying it as a in money an excess amount. Otherwise, the other guy will not sell it to me. Got it?
So usually on the credit side, what comes as um,
Okay.
the like you understand the question?
Okay. And you didn't say the full question.
No, like in as um
Okay. You
like,
want to know
instead
that
of
what
what comes
happens?
on the credit side.
Okay. I'll show you here. Give me a second. Company is having all the assets and liabilities. For example, assets is 150,000 and liabilities is 100,000. Okay. So your net asset value is net asset is 50,000. Clear.
Mm-hmm.
So when you purchase the company, assume that this is fair value. Okay.
Okay.
All the value you're having is fair value. Okay. Now you're going to record once you purchase the other company in your books, and the entry will be assets 150,000. I believe it is how much? 100,000. And you are having net asset, what you're getting is this much. Okay. For example, you're paying the company cash 75,000. Okay, to get the asset. So what is the benefit you are getting here? Okay, how much cash you are paying?
75.
75,000. Correct. What is the difference here? 25,000. Correct. That's a goodwill. Got it? Clear? Let's see.
Yeah.
Okay, the cash amount, whatever cash, it could be sometimes cash or shares of the other company. Clear? Maybe it's shares of the parent company. So whatever the excess we are paying from the above the net asset value, we call it as goodwill. Okay. Now, what if I'm paying only less? I'm paying only 45,000. Then what happens is called the bargain purchase. Okay, that's a gain I am having here. I'm paying only 45,000. So what happens here? Bargain purchase 5,000. This will be part of my P&L. Clear? This is a gain. Got it? Okay. Now, going forward. Calculation of goodwill or gain from a bargain purchase. Goodwill is an intangible asset reflecting the future economic benefits resulting from other assets acquired in the business combination that are not individually identified and separately recognized. Clear. So now you're getting some assets worth of 150,000 and liabilities of 100,000. So net asset you're getting 50,000. But you're paying, like for example, 75,000 you're paying. That means 25,000 you're paying excess. But you don't know on which asset you're paying this 25,000 more. Clear? Okay. Now that's why we call it as it's not individually identified and separately recognized, the goodwill element. Now, at the acquisition date, the acquirer recognizes and measures goodwill or a gain from bargain purchase. This measure is the difference between the fair value of the consideration transferred minus the fair value of the identified net assets acquired. Okay, that's the difference between the fair value of the consideration transferred minus the fair value of the identified net asset. So fair value of the asset transferred, right? We transferred here what? Cash. Clear?
Yeah.
Okay. Against the fair value of the net asset. Because when you take the fair value of assets and fair value of liabilities, basically the net asset, what you get is the fair value of the net asset. Clear? Okay. If the result is a positive, goodwill is recognized. Okay. If the if the result is positive, it's a goodwill. Okay. If the result is negative, it's a bargain purchase is recognized. A gain from bargain purchase is recognized. Clear?
Yeah.
Now, what happens? On the consolidation date, what we'll do is, okay, on the consolidation date, when we purchase the other company, we have to prepare a balance sheet, what we say, acquisition date P&L and balance sheet. Why? Because we need to know until that date how much profit they made. For those profits, we are not 100% eligible, correct? We are buying the other company on March, for example, today's 22nd. Until March, from January to March 22, whatever profit this company made, 100% profit share should be going to the old investors, correct?
Yeah.
From now onwards, we have, for example, 90% owners. Then from March 22nd till December 31st, whatever the profit company makes, out of that 90% will come to me, and only 10% goes to the Non-controlling interest people. Clear?
Mhm.
That's why. Consolidated financial reporting, acquisition date balance sheet. A balance sheet should be prepared that reports the financial position of the consolidated entity on the acquisition date. Okay. Now, step one, determine the amount of goodwill or gain from bargain purchase recognized on the business combination. Okay. For that, prepare the asset section of the consolidated balance sheet by adding the assets of the parent and subsidiary. As a parent, assets and liabilities are reported at 100% of the fair value. Land is revalued for its fair value and goodwill is recognized here. Let's see this example. Current assets of the parent is 140. Current assets of the liability is 40. Subsidy is 40. Then we have the consolidated current assets. Then current assets of parents and subsidiaries given. Then excess value of the land we calculate. Then goodwill from the transaction we brought it here. Clear? Okay. Basically, this is an abstract from the balance sheet. Clear? Just to show the assets only. Okay.
Okay.
Okay. Now, next, prepare the liability section of the consolidated balance sheet, adding the liabilities of the parents and subsidiary together. Now, fourth step, determine the non-controlling interest. Okay. And non-controlling interest or a minority interest exists when less than 100% of the acquire was acquired. That means if you are acquiring the other companies, less than 100%, means like 51% or 90% or 80% if you are acquiring, then only a non-controlling interest will exist. And non-controlling interest is not reported for every assets and liability. The entire non-controlling interest is reported as a single component of the consolidated equity. Clear?
Yes.
Okay. Now,
Yes.
because a consolidation is an acquisition of net asset, the subsidiaries equity accounts are eliminated. Clear?
Exactly. Understood.
Okay. I think your cat also, no, also understood, right?
Yes.
Okay.
Very much.
Okay. In the absence of a bargain purchase, the equity of the consolidated entity immediately after acquisition is the entity of the parent just prior to the acquisition plus the fair value of the non-controlling interest. Okay. Next, prepare the acquisition date balance sheet. After you calculating all these things, you have to prepare the acquisition balance sheet. Clear? Which will have the non-controlling interest element also. Now, here, candidates are not required to prepare a consolidated balance sheet on CMA examination, but you might get small portions from these areas. Clear?
Okay.
Now, there's an example here. Entity C acquired 80% of the outstanding common stock of entity D for 192,000. Okay. Now, entity D acquisition date fair value of the individual assets and liabilities were 350 and 140,000 respectively. The acquisition date non-controlling interest was 48,000. The goodwill is calculated as follows. How we will calculate the goodwill. Now, how much we are paying?
192,000.
192,000. This is for how much? 80% shares. Correct.
Mm.
So then they have given the non-controlling interest is 48,000. Okay.
Mm.
Say that is means 20%. Correct.
Yeah.
And their value is stated as 48,000. Okay. Now,
Yeah.
so this is actually the value of the company. Correct.
Mm-hmm.
This is the value which we are going to pay. 192 we are going to pay. Okay. And 48,000 is the non-controlling interest part. Clear?
Yeah.
Okay. Now, the assets which we are going to get. Assets fair value is how much? 350 and 140. Right. 350 and 140. This is the so this is the net asset is how much? So what is the consideration we are paying? The total value of the asset is 240, correct?
Yeah.
And the value which we are getting only 210. That means the difference is the goodwill. Clear?
Yeah.
Okay, now going forward. Next example. Using the information, assume that the acquisition date fair value of the unfavorable assets acquired was 400,000 instead of 350. Okay. What if the assets value was 400,000? Then what happens? The value of the business what you're getting is 240, but you are paying them the assets which you're getting is 260, right?
Yeah.
So you are having a gain on this transaction, correct?
Yeah.
So this 20,000 is called the gain on bargain purchase. Okay.
Yes.
Okay. Consolidated financial reporting sequence of the to the subsequent to the acquisition date. So after the acquisition date, what happens on the year end? What do we have to do? Clear. After the close of the fiscal year in which the combination occurred, the consolidated entity prepares its first full set of consolidated financial statement. Clear. The following step must be performed when preparing consolidated financial statement. All line items of assets, liabilities, expenses, gains, and other comprehensive incomes of subsidiary are added item by item to those of the parent. Clear?
Yeah.
Then these items are reported at the consolidated amounts. Okay. Now, no investment in the subsidiary account is presented in the consolidated financial statement. Clear? When you go back to our old example, even though there is investment, we will not take it to the consolidated. Clear? Okay. Now, the consolidated statements report the assets and liabilities of subsidiary and parents if they were a single economic entity. Okay. We added all of them together. Clear? Now, next. All the equity accounts of the subsidiary are eliminated, not presented in the consolidated financial statement. Retained earnings of the consolidated entity at the acquisition date consists solely of the retained earnings of the parent. Clear? Now, so here we won't take the equity of the subsidiary. What was the subsidiary's equity here? 50,000. We didn't take that. Clear?
Yeah.
Okay. Now, then what happens? The retained earnings of the consolidated entity at the acquisition date consists solely of the retained earnings of the parent only. Okay. Now, then goodwill from the acquisition of the subsidiary is presented separately in the non-current assets section of the consolidated balance sheet. Okay. So in the consolidated balance sheet, we will have one item which was not there before. That's the goodwill. Clear?
Yeah.
Next, intra balances, transactions, income and expenses must be eliminated in intra entity balances, transactions, income and expenses must be eliminated in full. Now, what is intra entity balances? Parent and subsidiary is doing businesses, and parent is having a receivable from subsidiary, 50,000. So what happens? 50,000 payable will be there in the subsidiary also, correct?
Yeah.
So that even if you consolidate also, it will get eliminated. Okay. One more thing to remember. The consolidation process, whatever we are doing, we are not doing in the books of accounts. Clear?
Huh?
You didn't get that. Whatever we are seeing here, we are not going to do in the financial statement. We are not going to do in the accounting records. Clear?
Yeah.
We will be doing only on the Excel sheet where we prepare the consolidation. Clear?
Yeah.
Okay, that's the point. So then, non-controlling interest is reported separately in one item, line item in the equity section. Clear?
Yeah.
Okay, now. Then consolidated net income. The consolidated income statement must present separate amounts of the following. That is the total consolidated net income will show. Then net income attributable to the NCI, non-controlling interest. and net income attributable to the shareholders of the parent company. Why? Because whatever amount we have shown in the balance sheet as non-controlling interest, this profit will go and add to the NCI. And this profit will go to add on our retained earnings. Clear?
Yeah.
Yeah, here is a question. You will understand better. Below are the separate statement of income of Platonic and Socratic, excluding Platon's share of income from Socratic on the year on December 31st, year 1. Platonic is the parent and Socratic is the subsidiary. Now, assume that the ownership percentage were the same as the acquisition date, 80%, and no items of OCA were recognized in year 1, and no intra-entity transactions occurred. That means we don't need to adjust anything. Correct. We have these two details. So what happens? Sales, we will add it together. 250 plus 120 is 370, and 120 plus 70, 190. Clear. Selling and administration, everything we add up together. Clear.
Yeah.
Then we will reach the net income. That is 39 plus 26. Clear. Next, we have to find out what is the net income for the NCA, non-controlling interest. So non-controlling interest, how much is the ownership percentage? 20%. Correct.
Yeah.
So 26,000, 20%, that is 5,200 is the non-controlling interest. And net income attributable to the platform's parents, shareholders is 59,800. Clear? That is 39,000 in full and 26,000 is 80%. Clear?
Okay.
Okay. Consolidated financial statement, financial reporting, intra-entity eliminations, year-end consolidated financial statements. Consolidated entity routinely conduct business with each other. The effect of these intra-entity transactions must be eliminated in full during the preparation of the financial statements. Now, consolidated financial statements reports the financial position, results of operations, cash flow, and consolidated entities were a single economic entity. Now, all line items in the consolidated financial statements must be presented at the amount that would have been reported if the intra-entity transaction have never occurred. Now, why we say this? Because when you go here, for example, assume that the 50,000 sales, whatever the subsidiary had, was from the COGS which the parent company purchased. Clear?
Okay.
All the purchase, 100% purchase from this subsidiary was done by the parent company. Clear? Now, in that case, we have to eliminate this particular purchase. Clear? Got it? Now, when you eliminate this particular purchase, what happens? You will have more profits there. You're eliminating. For example, assume all the COGS is from that particular company. Then what will be your profit? 92,500. Before, how much it was? 77,500. Clear? Why? Because this 15,000 profit, or would we say that, okay, this 15,000 is, for example, I will put it as 50,000. Okay. When we eliminate this, basically we are eliminating these two transactions. So what happens here? There is a profit inside this, right?
Yeah.
Okay. That profit also will get eliminated. Got it? No. Then one more thing was there. Okay. Okay. Two things. If you're doing a purchase and sale between the parent and company, you can either eliminate the whole purchase and sale, okay, or you can simply adjust in the stock. Okay. Why? Because if I sold something to parent company and this particular goods is here in the parent company's stock, then what happens? The profits on the stock will be there here. Clear?
Mm-hmm.
So to eliminate that, I can do an adjustment entry to eliminate the profits. Or I don't want to do that difficult math, then I can eliminate all the purchase and sale between these two companies. Clear?
Mm-hmm.
Okay. Now, so what happens here? All line items in the consolidated statements must be presented at the amounts that would have been reported if the intra-entity transaction had never occurred. Now, after adding all the assets, liabilities, and income statement items of a parent and subsidiary, eliminating journal entries for intra-entity transaction must be recorded for proper presentation of the consolidated financial statements. Clear?
Yeah.
Okay. Next, reciprocal balances. In a consolidated balance sheet, reciprocal balances such as receivables and payables between a parent and subsidiary are eliminated in the entirety, regardless of the portion of the subsidiary stock held by the parent. Okay. Now, what happens here? Let's see. Patronic separate balance sheet reports 12,600 as receivables and 8,500 as payable to Socratic. And the Socratic, what happens? There is 8,500 receivables and 12,600 payable. So when you consolidate, we will not show this in your consolidated statement. Clear? Why? Because automatically it gets eliminated also, right?
Mm.
This receivables and payables, when you put it together, it will become zero.
Yeah.
Okay. Now comes to the intra-entity inventory transactions, gross profit. Okay. Intra-entity transaction results in gross profit require more complex treatment. Profit from the sale of inventory between consolidated entity is a component of the net income of the entity that sold the inventory. Clear? Now, for example, assume that okay, at home, for example, there is a kid and a parent. Okay, and kid did something like kid made some what do we say toys, paper toys or something, and sold to the parent. Okay, and parent is giving the kid 100 dirhams. Okay, but the cost of making this particular paper toy is only 1 dirhams. According to the kids P&L, there will be 99 dirhams profit. Correct.
Yeah.
On that particular sale, and I am having that this particular paper toy with me in my stock. Okay. So when I consolidate, there is a 99 dirhams profit in my books. Correct.
Yeah.
Of the kids profit, which is in my books. If I have sold this to an outsider for 100 dirhams, then this 99 dirhams profit is not from the sale between the parent and subsidiary. It's a sale to outsider. Correct. In that case, we don't need to eliminate. But in this case, the stock is there. So what happened here? Simply, I made 1 dirham to 100 dirham.
Yeah.
So it will manipulate the users, right?
Yeah.
So that is why we are eliminating that profit element. Clear? Because this they are parent subsidiary, they can sell at any price they want.
Yeah.
To show profitability. Clear? Now, so profit from the sale of inventory between consolidated entities component of the net income of the entity that sold the inventory. However, the consolidated entity recognize profit on the exchange only in portion to the inventory that is sold to non-affiliated parties. That means the outsiders. Accordingly, the gross profit including the net income of the purchaser's book must be eliminated from the consolidated net income. Clear?
Yeah.
Now, a year-end journal entry eliminates the gross profit recognized in the inventory remaining on the purchaser's book. It also reduces the inventory account to the balance that would have been if the intra-entity transaction had never occurred. Got it? Now, from this inventory, what have I have 99 100 dirhams for the value of this inventory. From this, I will remove the 99 dirhams. Then what happens? My stock value will become $1. Clear?
Yeah.
Now, intra-entity non-current assets transactions. Let's have a 5 minutes break and come back.
Okay.
Okay. Yeah. Let's start.
Okay.
9 minutes ആയില്ലേ? So everybody is back?
Oh, yes.
Okay. Shelves. Okay. Okay, let's start that. Indu?
Yeah, I'm
Okay.
here.
Okay. So next comes to the intra-entity non-current asset transactions. Now, for example, so here we were discussing about inventory sales, right? Purchase and sale of inventory between the companies. So here we will eliminate the profit. Now here comes intra-entity non-asset transaction. Like for example, either the subsidiary or the parent is purchasing a non-current asset from the other company. Maybe it's a fixed asset they are purchasing. Then there will be gain or loss on sale of that particular transaction, and there will be depreciation. So we have to eliminate all those things. So we will assume that that particular transaction didn't occur at this period. Now, transfer of non-current assets require elimination of any gain or loss on the sale recognized on the intra-entity transaction. All the accounts relating to the assets transferred must be reported in the consolidated financial statement at the amount that would have been reported if the intra-entity transaction had never occurred. Okay. Now, thus the depreciation expense recognized in the consolidated statements must be the depreciation expense that would have been recognized in the seller's separate financial statement. Understood?
Yeah.
Okay. Why we do this? Because a subsidiary might sell their asset like worth of 50,000 dirhams to parent company for 500,000. Okay. And they will show a gain on their P&L. Clear?
Yeah.
And also the parent company can do a depreciation on 500,000, not 50,000. So we are trying to eliminate that particular transaction so that the depreciation shown will be only for 50,000 dirhams. Clear? Now, debt. When one entity holds the debt security of another entity with which it is consolidated, the elimination is treated as extinguishment of debt with recognition of any resulting gain or losses. That means we assume that we are settling that particular loan. Clear? So all accounts relating to the debt such as maturity amount, interest receivables, and interest income must be eliminated. And the premium or discount on the creditors and debtors books and any realized amortization is eliminated and recognized as a gain or loss on extinguishment of the period of purchase. Clear?
Yeah.
Okay. Now, reciprocal dividends. Now, parent will give dividend to subsidiary and subsidiary will give dividend to parents. Why? Because, for example, they are holding shares of each other's. Clear? So when consolidated entities hold reciprocal equity stakes, the portion of dividend paid to each other must be eliminated from the consolidated financial statement. Clear?
Yeah.
Okay. The portion of the parent's dividend paid to outside parties reduces the consolidated retained earnings, and the portion of the subsidiary's dividend paid to outside parties reduces any non-controlling interest. Clear?
Yeah.
Okay. Three types of consolidations are there. One is full consolidation, which what we discussed right now. Then equity method, where we discussed this before, right? If you are holding 20 to 50% shares, how we will record the transactions. Equity method is used when the investor has significant influence over a company, an investment of 20% or more, but less than 50% of the voting stock of the investee. Then we are required to follow the equity method. Now, preparing consolidated statement is not necessary when applying the equity method. Okay, then proportionate consolidation method. There, for example, you're having a joint venture with other company, then you will be consolidating on a proportionate basis. Proportionate consolidation method accounts for joint ventures or two or more entities. Assets and liabilities of a joint venture are recorded on the balance sheet in the proportion of the percentage of participation in each entity maintains in the joint venture. Like for example, we are having a 50% joint venture for a project, then I will take the 50% of the assets and liabilities, and the other party will take the 50% of the assets and liabilities. Clear? Okay. Now, let's do one thing. Let's do 4-5 questions and come back.
Yeah.
And, oh, correct. Business combination. There's only 12 questions, so we'll do. Who did all these questions? Okay. When preparing consolidation financial statement, the equity being accounted for is the. When preparing consolidation statement, the equity being accounted is for the which company?
Parent.
Yeah, parent. Sorry, economic entity. Now let's read why answer went wrong. Consolidation statements are not prepared for parent only. The consolidation financial statements are prepared as through the parent. The subsidiary or subsidiaries are as a single economic entity, not a legal entity that exists. So the entities. I read the question as equity, right? It was the entity being accounted as for.
Yeah.
My mistake. I read it as equity. Correct. Nobody corrected me also. Okay. Now, which of the following is not a characteristic of the voting interest model? That is VI model. Okay. For voting, this is VOE, right? Something for determining a controlling financial interest in the subsidy that would require consolidation of financial statement, those with the parent. So here, which of the following is not a characteristics of a voting interest? Clear?
Okay.
Controlling financial interest can exist with less than a majority ownership percentage. Okay. Controlling financial interest is usually established by owning more than 50% of the outstanding shares of the entity. That is actually voting interest model. The non-controlling shareholders substantial participative right can prevent the majority shareholders from having a controlling financial interest.
No.
Okay. This is also not an voting interest thing. Then consolidation is required when a parent owns a majority voting interest in the subsidiary, even if the subsidiary operates under foreign restrictions that limit the parent control. Okay, this is the voting interest thing. This is also voting interest. Let me read this. Okay.
Not a characteristic, right?
Yeah, not the characteristics we want to find out. Controlling financial interest can exist less than a majority ownership percentage.
How? No.
This could happen, right? A controlling financial interest can exist less than a majority ownership
Depending
percentage.
on the type of shares that they have. You had mentioned that.
Yeah.
So it's not that. Non-controlling shareholder substantiative participating rights
Can prevent the majority shareholder from having a controlling financial interest. Like this is where the
that is
non-control.
not possible.
Yeah,
Right?
this is the non-voting interest model, right?
Yeah, voting interest model.
They're asking not a character of voting interest model. In a voting interest model, this what we say. I'm confused with these two options. Let's see. What is the question again? Okay, which of the following is not a characteristic of a voting interest model? So let's do one thing. Hide this not element and read. Which of the following is a characteristic of a voting interest model? Now, controlling financial interest can exist when the major less than. Why D is the correct answer? The statement is incorrect. So the correct answer to the question. If a majority-owned subsidiary operates under foreign restriction control, or other government impose uncertainties that limit the parent's ability to control the subsidiary, the parent may not have a controlling financial interest. In that case, under the voting interest model, the financial statement of the consolidated should not be consolidated with those of the parent, even though the parents own a majority voting interest in the subsidiary. Okay, this is a new information. Got it?
Yeah.
Yeah, which we didn't read this portion. It was not in the textbook.
It was
Okay.
not there.
Yeah. So even if it's a subsidiary in a foreign country, which is under what we say, major
So if there are like rules
operates
in place,
under foreign restrictions that limits the parent control. Okay. If it is in
then
the foreign country and without the limit, there is no limit for the parent control, then there is no problem. The
yeah,
problem is the restriction is there.
yeah,
Then you can't consider it as a what we say subsidiary. Clear. You don't have the control. Okay.
Mhm.
Next one. Panko owns 90% of the voting stocks of Swani Corporation. After consolidated financial statements have been prepared, the entries to eliminate intercompany payables and receivables will be.
Not reflected in accounts of either company.
Either companies, yeah. Yeah. Why? Because the adjustments that are made on the consolidated statements to eliminate intercompany transactions are not actually recorded in the books of either companies, books of the either company. They are simply adjustment in the worksheet that is used to prepare the consolidated account balances. Clear?
Yeah.
This makes sense because even though the intercompany payables and receivables are eliminated in the consolidated process, each of the two companies doesn't have a payable or receivables that will they have to collect or pay. Therefore, these intercompany payables and receivables cannot be eliminated from the accounts of the consolidated companies because they do exist, still exist. Clear?
Yeah.
Okay. Okay. That's it. Then next topic is that short-term items. Okay to continue? All of you?
I'm okay.
Okay. Shilps, Bilal, Hindu.
Fine.
Okay. Okay. Hindu.
Yep.
Okay. Yes. Now, we are going to discuss the biggest items in the current assets, biggest item in the balance sheet, which is the accounts receivable and the inventory. Clear. Any company, if you take, if it's a service oriented company, the majority of your current asset will be in your accounts receivable. Or if it's a trading company, you will be having amounts in receivables as well as inventory. Now, coming to the receivables part, here we'll be discussing about credit losses, accounting for factoring, and all those things. Then inventory also we'll discuss about different cost flow assumptions and those things. Now, when we say accounts receivable, we are talking about the trade receivables. So accounts receivables or trade receivables are amounts owed to an entity by its customers resulting from credit sales in the ordinary course of business that are due in the customary trade terms. So what is the customary trade terms? That means normally what are the trade terms we are giving to all other customers? The same terms. If we are giving any particular sale to somebody, normally we give 30 days credit to a customer, but for this particular customer, you are giving 180 days credit. Then you can't consider it as your trade receivables. It is not a normal Sale, correct. You might have some sort of relationship with that guy. Clear?
Mhm.
Okay. Now, the recording of receivables, which often coincide with the revenue recognition, is consistent with the accrual method of accounting. Clear? If you're following a cash basis of accounting, you will never have trade receivables in your books. Correct?
Yeah.
So you are having trade receivables only because you are following accrual method of accounting. And because of accrual method of accounting you are having, the revenue recognition is also connected to the receivables. You can't record any receivables without any sales. Correct?
Mhm.
Then coming to the allowance for credit losses. So here in US we call provision for bad debts as allowance for credit losses. So get used to this wording, allowance for credit losses. There is nothing called provision for bad debts here. We'll the same thing, but we use a different name. Okay. Allowance for credit losses. Now, the allowance for credit losses is a contra asset that reduces accounts receivable in the entity's balance sheet. Now, what is a contra asset? So anything having a credit balance, but we are showing under the assets category. Correct.
Mhm.
In a negative symbol.
Yeah.
So when we present receivables, we will have AR less allowance for credit losses. Clear?
Mhm.
So this is an asset. This is a contra asset. Clear?
Mhm.
Now, so this account is used to keep track of management's estimate for the amount of accounts receivable that the entity estimate it will not be able to collect. Clear?
Mhm.
Next comes the credit loss expense. This is the actual credit loss we are going to have. So credit loss expense is the income statement account used to keep track of the expenses related to the estimated credit losses. So when you have a provision, your journal entry will be credit loss expense account debtor to lines. For example, 15,000 is the amount. Then, so what happens? This is P&L item. This is balance sheet item. Clear?
Mhm.
Now, the balance sheet presentation. Receivables should be separated into current and non-current portions. Okay. Now, current and non-current. Why? Because if you are giving somebody some customer credit of more than 360 days, like 1 year, then that receivables you have to show separately under non-current assets. Clear?
Uh-huh.
Okay. Now, most of the entities' receivables are classified as current asset because they are expected to be collected within 1 year or the entity's normal operating cycle. Then, current assets, current accounts receivables are reported in the balance sheet at net realizable value. That is net of any allowances for credit losses, allowance for sales returns, and billing adjustments. Clear?
Mhm.
So we show the net amount here. Why? Because this is a net amount, right?
Yeah.
Net ARR. That's why we call it as net realizable value. How much money we are going to receive. For example, we had allowance for sales returns. So we will bring that also. Less allowance for sales return. Clear?
Mhm.
Okay. Now, when non-current receivables are measured at net present value of future cash flows expected to be collected. So, try to understand the difference here. Current assets, current accounts receivable we will show under net realizable value, and non-current receivable we show under net present value of the future cash flows. Clear?
Mhm.
So net present value calculation we discussed in last class, right? You remember?
Yeah.
Yeah. We take the present value of each dollar value, multiply with the future cash flow. Like for example, this particular sales AR is for 3 years, then 3 years present value we have to calculate there. Clear?
Mhm.
Now, allowance method. Okay, there is actually two methods. One is allowance method and direct write-off method. Okay, direct write-off means you don't give provision every year. Provision for bad debts, provision for uncollectibles, or what you say, allowance for uncollectibles, you don't show every year. What you do is whenever there is a bad debt, okay, you will recognize in your P&L. Clear?
Mm-hmm.
At that time, your entry will be direct write-off means. So your entry will be what do you say? What is the account? Okay, credit loss expense account applied to accounts receivable. Okay, for example, 15,000. Now, what happens here for the direct write-off, your P&L will not be consistent. Okay. Also, there is a matching concept issue here. Why? Because this particular customer, you might have sold this goods to him on 2020, and you are trying to follow up with him, but now you realize this particular company is bankrupt. They liquidated in 2025 balance sheet. So now what happens? You are going to write off this 15,000 in your current year P&L, correct?
Yeah.
So this 15,000 doesn't match with your current year revenue.
Yeah.
So that is a problem with the direct write-off. Okay. GAAP doesn't allow this. Okay. GAAP doesn't allow this, but one person will allow. One people will allow it. Who is that? Income tax.
Why?
Okay. Got it. Why? Why? Okay. Why? Because they don't allow the provisions. Why? Because the provisions I can manipulate. So allowance for credit losses, who decides 15,000? Management. If I decide that, okay, my loss is not 15,000, that is 75,000 I am expecting as credit loss. Then 75,000 will go here, right?
Yeah.
The P&L. Then from the P&L, 75,000 is gone, means I'm paying only lesser tax.
Oh, okay.
I can manipulate, I can play on the profits, correct? So that is why they say, okay, allowance method you can follow, but under US GAAP. When it comes to the tax rules, they say, okay, do you have real credit loss? Then claim it. Clear?
Okay.
Okay. So allowance method, which is required under GAAP. The allowance method attempts to match credit loss expense with the related revenue. This method is required under GAAP. As specific accounts receivables are written off, they are charged to the allowance account. Write-offs doesn't affect the carrying amount of the net accounts receivable balance because the reduction of credit gross accounts receivables and the allowance are the same. The write-off of a particular account has no effect on expenses. Okay. Did you understand this part? If no, tell me. All clear?
Yeah.
Others? Bilal, Shilpa?
Yes.
Okay, all good. Okay, now. Okay, fine. Okay, in the balance sheet, the carrying amount of the accounts receivable is reported at net amount expected to be collected. Okay, so we say show accounts receivable, then we have allowance for credit losses. Okay, then under the allowance method, two approaches to calculate the amount charged to the credit loss expense is there. One is the income statement approach, one is the balance sheet approach. Okay, now before going to income statement approach and balance sheet approach, I'll show you something. So you have accounts receivable list. Okay. Name code 1000. For example, this is your accounts receivable list. Okay.
Mm-hmm.
This from where you get? From your AR module. Correct.
Yeah.
And same amount should reflect in your GL also. Correct.
Yeah.
General ledger, you will have accounts receivable. The amount will be 120,000. Clear. Then in GL you have less provision. Allowance through credit loss. For example, your provision is like 15,000. Okay. So your net AR is, this is what you're going to show in your balance sheet. Clear?
Yeah.
Okay. Now what happens in future, next year what happened, or this year itself, for example, I became default. You figured out that I'm becoming a bad debt. Clear? So what
Mhm.
will be your journal entry? Okay. For this allowance, your entry will be credit loss expense accounted to allowance credit loss. That is 15,000, correct?
10,000.
No, that's 15,000 provision I'm putting, the above amount.
Okay.
Okay. Now what happened? Now you realize that I became bad. Now your journal entry will be what? You have to remove me from the books, right?
So allowance for credit loss debted to you?
To who? To Nadeem Co.
Nothing. Who?
Okay. Nadeem Co is under what? AR. Correct.
Yeah.
So 10,000 will be removed from here and 10,000 will be removed from here. So what happens in your books? After this journal entry, you will have Nadeem being removed. Correct.
Yeah.
So Nadeem is removed, so it becomes 110. Okay. Also from here, you are removing 10,000. Clear?
Yeah.
So what happens to your AR? AR is the same even after this particular journal entry. Got it?
Yeah.
This is what?
So once more, sir.
Great.
That is why I asked, did you understand what I said, what we read here? Okay, once again, ask, Willard. Come on.
Why we get the same amount here? Net AR.
Why we get the same amount? Because we are removing 10,000 from where? Accounts receivable, correct?
Okay.
Yeah.
So here we are having net amount. This is 120 minus 15.
Yeah.
Okay, this is 120 minus 15,000. Now, after the journal entry also, what happens here, after this particular journal entry, 10,000 is reduced from the AR, okay? And
Okay.
10,000 is reduced from the allowance also.
Okay.
So that is why the net amount is the
Yeah.
same. So you will not see any change in the balance sheet. Got it? And even though Nadeem became a bad debt also, it will not affect your P&L.
Yeah.
Our basic idea was that it should not affect any bad debts coming. It should not affect your P&L. Why? Because this 15,000, what is your allowance you're providing every year? That will be the consistent one. Clear? Okay. Next comes to the income statement approach and balance sheet approach. So the income statement approach, the percentage of sale is what we are going to take as the provision. So here we said 15,000 is the provision we are keeping, right? But how we calculate this 15,000? What was the basis of this 15,000? Okay, this basis could be on the basis of income statement approach, or balance sheet approach. Clear?
Okay.
So now income statement approach is where they calculate the percentage of credit loss on the basis of sales, credit sales. Okay. Now, under the income statement approach, the entity estimates the periodic credit loss expense as a percentage of the sales on credit. Clear? Keep in mind,
Okay.
in examination, they will give you total sales. And they say out of that 10% is cash sales. Then you have to find out what is the 90% credit sales. Then only you should continue the calculations. Clear? Now,
Yeah.
the ending balance of the allowance for credit loss is determined after all the activities in the allowance account is recorded during the period. Now, if there is any bad debts you have to record, first you have to record this bad debt. Then only you will go and calculate the credit losses. Clear? The ending balance of the allowance for credit losses is determined after all the activities in the allowance account is recorded during the period. Clear?
Yeah.
Okay, now. So there is an example here. Midberg company has following unadjusted account balance of the year end. Cash is 85 and accounts receivable is 100,000. Allowance for credit losses is 2,000 and sales on credit is 500,000. Now the company, based on its experience, Midberg expects credit losses to average 2% of the credit sales. Whatever they do, 2% of the sales is going to be losses. Clear? Now, thus the estimated credit loss expenses, how much? 10,000. Now, already they have 2,000 as provision. So now again, you are going to put 10,000 as your provision. Clear?
Yeah.
So allowance for the credit losses, the balance sheet amount will be 12,000, but in the P&L, your expense will be only 10,000. Clear?
Yeah.
Okay. Now, then you get a net receivables as 88,000. Clear? Okay. Now, next comes the balance sheet approach. Here we are trying to figure out how much percentage of the receivables should be your provision. Clear?
Yeah.
Now, here we are trying to figure out what is the ending balance. Here in this case, we are calculating the P&L element. Clear?
Yeah.
Okay. Now, under this approach, the ending balance of the allowance for credit loss is a percentage of the ending balance of the accounts receivable. Credit loss expense reflect the adjustment of the allowance to its correct ending balances. Assume that the above example, the Midberg expenses are 6% of the accounts receivable are determined to be uncollectible. Okay, so what is the accounts receivable here? 100,000. 100,000, 6% they are expected to be uncollectible. Clear? The total 6,000 should be the closing balance of the credit loss allowances. Clear?
Total. Okay.
So the closing balance should be 6,000. So already you have a 2,000 allowance, correct?
Yeah.
So current year allowance will be 4,000.
Okay.
The credit loss expenses will be 4,000 and allowance of credit loss will be 4,000. So your ending balance will become 6,000. Clear?
Okay.
Both the methods you understood the difference, right?
Yeah.
Okay. Now, second one. Normally in companies, we don't take a percentage of the total accounts receivable. We do the aging report, right? On the basis of aging report, you do the provisions, correct? Okay. Now comes to the aging schedule. An entity rarely experiences a single rate of uncollectability on its accounts receivables. For this reason, entities use balance sheet approach to estimate expected credit losses for the accounts receivable, generally preparing an aging schedule. Now, for example, in this case, this is on the basis of amounts. Okay, invoice amounts. Now 0 to 100 and 100 to 1,000, 1,000 to 5,000. So they have divided the days, 30 days, less than 30, 31 to 60, 60 to 90, and more above 90 days. So from this, what do you feel? Which receivables could become the bad? The oldest ones, right?
Yeah. 1,000.
So 1,000. So 1,000, you have to provide higher provision for those things, those amounts. Clear? So management will decide the percentages on that basis. Okay. Above 90 days, we will consider 20%. This is all management's calls. Management will
Okay.
decide what percentage they need. Clear? Either they can take start with 10% or 50%, whatever they want. Clear? Now, because the allowance currently has balance of 2,000, the following entries required. Now, ending balance should be 5,280. Clear? Already they have 2,000 as their opening balance. Now their credit loss expense will be 3,280.
Yeah.
Correct. Okay. Now, so in both methods, you get different answers. Clear. Here it is 9,400. Why? Because you took a single rate. In practical life, what we do is we take the accounts receivable on the basis of the customer. Aging will be done on the basis of customer, right? And we see each customer, whether this customer will become bad or not, how long it's been outstanding for this particular customer and all. Clear? Reconciliation summaries. The following equations illustrates reconciliation for the beginning and ending balance of gross accounts receivables. How will take beginning accounts receivables plus credit sales during the period minus cash collection during on the credit sales minus accounts receivable write-off during the period, then which will give you ending accounts receivable. Clear?
Yeah.
Then on the allowance for credit losses, also beginning allowances plus credit loss expenses recognized in the period minus accounts receivables write-off, then plus collection of accounts receivable previously written off. Now, assume that you thought I became bad, correct? But later on, I came back and gave you money.
Okay.
Then what will be your entry? You'll receive cash from me, right?
Yeah.
So cash account debtor to allowance for credit losses. Clear? So cash will be 10,000 and allowance for credit loss will be 10,000. Now what happens to your balance sheet? Accounts receivable will be the same, right?
Yeah.
The credit losses will be 15,000. Clear? Got
Yeah.
it? Why? Because already you collected this 100,000, 10,000, right?
Yeah.
That is why your
In
net
cash.
receivables change.
Yeah.
Okay. Okay. Give me 1 second. Yeah.
I have to go.
You have to go, right. So allowance for customers right of sales return, we will continue in the next class.
Yes.
Okay. Yeah. So thank you guys. Meet you next week.
Thank you.
Bye.
Thank